Taxes. They're inevitable, and most people dread them. But what if I told you taxes could actually be one of your greatest financial advantages? Instead of fearing tax season, imagine using smart strategies to keep more of your money, speed up your path to financial freedom, and retire earlier than you thought possible. In this episode, I'm breaking down practical, easy-to-use tax moves that anyone can start today in order to optimize like a pro. Hey all, welcome to today's episode of Escape the Clock, the podcast where I, the author of the book, goes through different strategies to help you make your plan. I've been thinking a lot about how to make this podcast more useful and engaging for you, and I really love diving deep into a lot of these topics, but I do notice that a lot of the episodes are running a bit long, and I know that can feel a bit overwhelming. And I'm not really a fan of splitting them up too much because I know we'll lose a lot of the momentum and clarity of how these projects can be sequenced to really help you hit your goals. But today, starting with this episode, I'm going to keep each of the project focused to a time-capped number of key steps, between 5 to 10 tasks, and it should run roughly around 5 to 10 minutes. That way we can cover multiple actual ideas in one session without dragging things out too far. If you do want me to go deeper on a topic, I'll share extra details in the newsletter, or I can follow up with another episode. So please let me know. Just post a comment, or you can reach out to me at escapetheclockmedia@gmail.com, and I'll make sure to get that on the backlog. Today, we're talking about taxes. Might sound pretty boring because today isn't tax day, but it can be the day you start making your taxes work for you. Most people only think about taxes when April rolls around. But real tax planning is a year-round strategy, and ignoring it can cost you thousands of dollars. If you're aiming for early retirement or just financial freedom in general, mastering taxes is one of the fastest ways to speed your path to freedom. And the truth is, you have more control over your tax bill than you realize. In this episode, I'm breaking down 4 practical moves you can start using now. Simple, actionable steps that can save you a lot of money over time. 4 projects, 4 big strategies that'll help you optimize a lifetime of taxes. Let's get started. Do you know what tax bracket you're in? Do you know how close you are to the next one? Do you know what bracket you want to be in when you're retired? Could where you put your money today save you thousands in taxes down the road? Or have you wondered how to minimize your taxes no matter how much income you earn? The first project is going to look into and answer all of these questions because most people don't fully understand the real tax bracket or how different income sources can push them into higher rates. Without this insight, you risk overpaying taxes, missing valuable deductions, and overlooking opportunities like the 0% capital gains bracket. And where you contribute your money and where you take your withdrawals, these can be strategically managed. If you can keep yourself into the lowest possible tax bracket over your lifetime, you can maximize your savings and accelerate yourself to your financial goals. And for this episode, I'd like to introduce you to Setzer. Setzer is earning good money, but his annual tax bills have become a major source of stress. He's done gambling with his taxes and worried about how much worse his tax situation might even be when he's retired. He wants to do more with his money, like giving to causes he cares about, but high tax bills can stand in the way. So I'm going to dive into some key strategies now that can help Setzer and maybe yourself when it comes to your plan. The first part is when you're in your higher income earning years, such as when you're working. This is when you really have a great opportunity to contribute to pre-tax accounts. This is to lower your marginal tax rate, and this will allow you to withdraw from taxable accounts. All of this is to help optimize your tax situation when you're earning the most money, and therefore your tax bracket is higher. But to get into this strategy, first I'm going to have to just explain what tax brackets are and how they work. So in general, tax brackets help divide your income into ranges, and each range has a different taxable rate. Your marginal tax rate is the amount of rate that you will pay on your last dollar earned, not on your entire earned income for the year. slow down for a second. Let's take an example. Let's say your marginal tax rate is 22%, meaning you're in the 22% tax bracket. This is because the amount of money you earned for the year ended up in passing enough thresholds to put you into the 22% tax rate. Well, you don't actually pay 22% on all of the money you earn for the year. It's marginalized. 10% will be paid on the first $10,000 that you earned, meaning that you actually still paid within the 10% tax bracket, even though you ended up in the 22 tax bracket at the end. So of that $10,000 of that 10% bracket, you paid $1,000 in taxes. Then the next tax bracket is 12%. So in that case, you pay 12% taxes on the next $30,000 that you made. That would have been $3,600. Then for your 22% bracket, let's say the remaining amount of money that you had made that year was $5,000, that would have been $1,100. So you would have paid taxes in the 10%, the 12%, and the 22%. Therefore, lower portions of your income are taxed at lower rates. So your effective tax rate is always less than your marginal rate. And as of 2025, the year of this recording, tax brackets are 10%, 12, 22, 24, 32%, 35, and 37%. And where you fall on that completely depends on both your income that you make and how you file your taxes. You can file your taxes by yourself, a single filer. If you were to do that, then if your income was $11,000 or less, you would be in that lowest tax bracket, 10%. If you're married and decide to file jointly, you don't have to, but let's say you do, then the limit for the 10% tax bracket increases. It actually goes up, it doubles. It goes to $22,000. And so how you can think right away, based on how you file, you already have an optimization opportunity. You might pay a lot less taxes filing one way versus another. There actually are multiple options for how you file. The highest bracket is 37%. Now, to get to this point, it would require you to make at least $578,125 of income for an individual in a given year. If you were to be married, file jointly, that would jump as well, up to $693,750. Now, these are the latest tax numbers. This actually changes every year. The IRS will actually make adjustments, pushing up and hopefully giving us more room in these different thresholds so that, we can help optimize even better. But the main idea here is as your income climbs, you may find yourself spilling into higher and higher tax brackets and therefore paying more taxes. It's not a punishment, but it can feel like it as we're doing better. At least I know that's how I felt. The good news here is that pre-tax accounts, these are things like a traditional 401k or traditional IRA. These will allow us to contribute money before it's taxed. This can reduce our overall taxable income for the year. So think of it this way. Instead of, let's say you made $100,000 for that year. Well, if you were able to put $10,000 of that into a pre-tax account, well, the IRS doesn't see that $10,000. They're not able to tax it yet. They actually only see $90,000 of taxable income from the year. So that can actually help you avoid spilling into a higher tax bracket and paying more marginalized taxes. So lower taxable income can keep you within a lower tax bracket, meaning you will pay less taxes now. And while you're working, this can be a big deal. Taxes will be paid later, though, when you withdraw. So it's not like you're not going to pay taxes in these accounts ever. You're deferring it. Ideally, to a retirement period when your income and therefore tax rates will be much, much lower. This is what I mean by optimizing. We're going to make sure we can pay less taxes now, setting ourselves up for the future where we'll also pay less taxes later, therefore paying even more and less taxes overall. Therefore, you can lower how much tax you pay in your high income earning years by contributing more to these tax deferred accounts, knowing that later when you take the money back out and pay taxes then, that you're still in that lower income bracket. Let's talk about that. Let's assume you either are fully retired or you're in an early retirement situation. This is where withdrawing from your tax deferred accounts to keep your marginal tax rate low can actually be a great strategy. So besides these pre-tax accounts, it's worth mentioning there are other types of retirement accounts, in particular after-tax accounts like a Roth IRA. Now, if you remember me talking about these before, the difference is in the Roth IRAs, you've already paid taxes. When you put the money in, you're paying taxes on that. The benefit of that is you're not going to pay taxes again. They can't make you pay taxes twice on it. So when you get around to taking the money out of that Roth, even if it grew wildly, you're not going to pay any taxes on the gains or on that withdrawal, and assuming you would avoid the penalty and you don't withdraw early. Anyways, you can continue to optimize even when you're in a low income situation, such as if you're not working, early retirement, full retirement. And so you pay taxes when you put the money in these Roths, but you'll never pay taxes again, making them ideal for later in life, when you know you need to further optimize your tax situation. If you know later, hey, I'm trying to stay in a specific bracket, well, I can use my Roth and know I won't be contributing to my tax situation. So while in low income or early retirement, don't withdraw from Roths or any after-tax account. Leave them alone. You want them to grow. You want to maximize the advantage you have later so that you can optimize better in the future. Additionally, you should really think about optimizing just in general your withholdings and deductions every single year. And what I mean by this is that when you go in and you review your tax setup, and you usually do this with your employer through like a W-4 form, you really should be looking and trying to estimate your expected income and reflecting your deductions as best as you can to avoid overpaying. Unless you want to give the government an interest-free loan. I personally don't like that idea. So I try to avoid overpaying. But you might be okay with that, or you might try to avoid underpaying, which can really suck because underpaying means you're going to have a big bill coming later and might put you in position of penalties. So I always like to get as close to balanced as possible there so that my tax bill is as reflective of what I would expect as possible, and I can really make sure I'm optimizing all of my deductions. And fine-tuning your withholdings to keep your tax payments balanced throughout the year, this can just really help you later avoid a situation where you end up with a big bill or even a big refund, and therefore your planning is a little easier. And just try to be strategic about your deductions. There's a standard deduction. It's a flat number. It also gets updated annually by the IRS, but you can also itemize your deductions. If you take the standard deduction, you're going to subtract that amount from your taxable income, just like if you were putting money into those pre-tax accounts. So on top of that $10,000 I used as an example before, you could put the current standard deduction rate. Let's say it's $2,700. Also on top of that, further reducing your brackets. If you itemize your deductions, though, you might be able to get further. And usually a tax professional, this is a big thing they will do for you. They're going to go in, they're going to ask you about all these questions. And these questions are helping find areas they know they can get you deductions. This can be things like your mortgage interest that you paid for the year. This can be charitable donations. This can be even state taxes. Like, it just depends. And so as you go through this, or home improvements, there's lots of things. And as they go through this and they itemize the number, they might find this number is greater than the standard deduction number. Therefore, we're going to get this so we can optimize even better. And you're going to choose. You're going to choose whatever you want to do to lower your taxable income. But most people end up taking the standard deduction just because it's simpler, and itemizing can be a lot of work. But if you're tracking your deductions, you know what a deduction is, and you're even strategically choosing to do stuff that you can get a deduction on, maybe to improve your energy bill and to save yourself on taxes. Well, now you're doing better on all ends. The last thing I want to talk about for this project is charitable donations, because giving actually reduces your taxable income as well. And it's part of how we're itemizing those deductions. When you're donating money or goods, it doesn't have to be money, it can be actual physical things like clothing or whatever. When you're donating to qualified charities, you can deduct the donation amount from your income. This is your third part of your strategy. First is getting money into those retirement accounts. That's a big one. Then it's going for those deductions. And here it's going even further by donating. This is actually a really common thing that more wealthier people will do to ensure they're optimizing their taxes. And you can use different strategies here, like bunching multiple years of donations into one tax year, the one that you know is going to be the most painful, or to use a donor advised funds so you can increase the tax benefit by maximizing all your deductions all at once. All these strategies together can really help quite a bit. And let's talk about Setzer again for a moment, because he can use these himself. Let's assume that he starts maximizing his contributions to a pre-tax retirement account, like a pre-tax 401k, and he opens a traditional IRA on top of that. This will help him lower his marginal tax rate. So his tax situation he had before, now all of a sudden he's paying less taxes because he's putting money into retirement accounts. He can also start to bunch up charitable donations and leverage donor advised funds to start giving without feeling like he's contributing to his tax problem. And he can also update his withholdings and review that with even a CPA to ensure that he's as close as possible to paying what he owes every month of the year. And then at the end of the year, when it's time to go in April, when it's time to do taxes, itemizing his deductions to make sure he's getting the most and really getting as far as possible. So in general, optimizing income tax is great. But honestly, there's a lot more we can do than that. For instance, what about all of our investments? Next, I'll cover how Setzer and you can optimize for capital gains. Have you ever hesitated to sell an investment because of the tax hit? Do you know if your gains are short-term or long-term? Or how capital gains are taxed differently than income tax? As investors, we often avoid selling investments because we don't want to pay taxes. But strategic selling can lower our lifetime tax bill. Tax loss and tax gain harvesting are very powerful strategies that can help us offset taxes and optimize between high and low income earning years. Let's go back to Setzer for a minute. He's gone through and optimized his annual tax situation, but he has investments as well, some with large gains, but others with losses. And he's avoided selling anything because he was worried about how it would affect his end of year taxes. Well, with some of these strategies, he'll be able to make some improvements there. The first key strategy to consider for your project is when you have gains. And this is what we're working towards, right? We're doing investments, real estate, stock market, whatever it is, because we're hoping for appreciation. We're hoping that we'll have gains that we can use to end up creating more cash for ourselves and our lives. Well, tax gain harvesting will allow us to pay up to a limit each year. First, we have to understand short-term versus long-term capital gains. And with that, it'll help us determine how to use tax gain harvesting most effectively. First is short-term capital gains. Those come from selling any assets we held for a year or less. And these are taxed as no ordinary income. So this is important. If I were to buy a stock now and I were to sell it before the end of the year, then I would still be in the short-term capital gains category, meaning anything I did profit-wise all gets piled right on top of my marginalized tax rate as income. So I got to be careful there. That means buying and selling or just doing normal trading throughout the year could make my tax situation worse. It could push me into a new tax bracket. But long-term capital gains, this comes from anything I was able to hold for more than a year. And this is taxed at different rates. And that's actually really important. Capital gains taxation can be an optimization strategy. The rates are 0%, 15%, or 20%. Again, it is dependent on your taxable income. So as you're optimizing one area, you're actually helping optimize the other area. But let's get into it for a minute, because you might have heard 0%. That's probably where you want to land. And that is the strategy here. The strategy with tax gain harvesting is to ensure that you're staying in the 0% category, paying no taxes. That is as optimal as you can get. So imagine your taxable income falls below the thresholds and it's long-term capital gains. So that means you've had, let's just use the stock market. You bought a stock, it's at least a year later, maybe more, and you have some good gains, you want to sell it. First, we need to figure out our taxable income for the year. That's step one. This is so we can see how much room we have before hitting the 0% gain limit. Because selling investments will realize gains up to that limit. And we also have to keep in mind that once we sell, it's not like we can just go buy it back and do that again anytime soon. There will be this thing called a wash sale rule, but I'll get to that in a moment. Let's go back to how to do the harvesting. Let's assume you're married and your overall taxable income for the year is $70,000. You decide to sell $20,000 of stock that you had bought for $10,000. That means you got $10,000 of gain. That's great, because in this case, you're going to pay $0 in taxes because you're still under the threshold, staying in that 0% capital gains category. In this case, you needed to stay under $94,050. And if you were to buy it back right away, now what's happening is you're increasing your cost basis. So that $10,000 of stock you bought that had appreciated, but because it's worth $20,000 now, the cost basis is jumping to that as well. So the gains is that difference. And knowing that the gains are the taxable part, what we can do is optimize for where we're sitting income-wise and how we're filing to make sure that we're staying in that 0% threshold. This is extremely powerful in early retirement or low income years because we're already maximizing the amount of room we have. So if you know that mostly what you're going to do is live off gains, then you can maximize tax gain harvesting, making that in a way your income for the year. So your income, actual income, is like maybe next to zero, but your gains are all, as long as you're staying in that 0% category, you can maximize the amount of cash that you can cash out during those years. But not everything is always a gain. Sometimes we have losses as well. The good news is there's actually a tax optimization strategy for those. Tax loss harvesting means that we can sell our investments that have lost value to realize the loss, because the loss doesn't exist until we actually sell it. And what this means is that we are using these losses to offset other gains. This further reduces our taxable gains dollar for dollar. This is a very, very powerful strategy. And it actually can help us feel a little safer when we're investing, because investing is about taking risk. Not everything's going to be a winner, but knowing that we're able to offset the big wins with any losses that we have to optimize taxes, that means we are still getting ahead. So in this case, what we're doing is we're using losses to offset unlimited amount of capital gains in the same tax year, and there's no limit on this. So let's say you wanted to go large and sell $300,000 worth of gains in a year. Well, you could actually sell $300 worth of losses and then not have to pay any taxes on those gains. As you can imagine, selling $300 of losses hurts, but also paying no taxes, that can really do a lot for you. But keep in mind, if you were able to tax gain harvest it, then you're still paying $0 in taxes, but you're just spreading it apart. Instead of selling at $300,000 at once, you're doing it in chunks. So you should figure out what the right strategy is for you. It is not worth intentionally getting losses in order to get a tax optimization. That would be silly. But when we do have losses, it can be really powerful. Let's say, though, you don't really have any big gains that you're looking to sell for the year. Is this strategy any good? And the answer is, yeah, it actually could still make sense, because you can also use your losses to deduct up to $3,000 per year of ordinary income, or $1,500 if you're not filing married or jointly. What I mean here is, I mentioned all those other ways to lower your taxable income for the year. You can get another $3,000 off, which can be more than your standard deduction just from those losses. but it's a $3,000 max or $1,500 max. Again, based on how you file. So keep that in mind. But that can be helpful as well. Also, any unused losses can be carried forward to a future year indefinitely. So you could actually go in and sell the more losses than you're able to deduct for off of income for a year, and then be optimizing future years. So this can be a very powerful strategy. Keep in mind, though, I mentioned this before, there's a wash sale rule. If you do sell a security at a loss, and then you buy back the same or pretty identical looking security within, I think it's between 30 days. There's a 30 day before, 30 day after. So it's like a 60 day window. The loss is disallowed for tax purposes. So this is a big deal. Don't screw yourself because you're like, great, I'm going to sell this loss, but I know this stock's going to be fine. And I'm going to just buy it right back. And then I'm going to get those gains and I'm going to get the tax optimization. No, it will not work like that. So just keep that in mind when you're doing it. Awesome. So with all these things in mind, how could Setzer maybe use these to improve his investment situation when it comes to taxes? Well, he's still working and he realizes that selling too many of his gains could create a tax headache for himself. He's making too much income. Still, he gets close to the end of the year. And so he can actually look and see where he stands. He can work with a CPA and calculate his current income and how much room he has. And he can look at the capital gains brackets. And then he can understand, hey, I could actually harvest so much. Now, the number's probably smaller, though, because he's working. And so the more money he's making, the harder it's going to be for him to harvest. But still, he can also consider shedding off some losses to get more room there. He can start to deduct either dollar for dollar, selling his losses to get more harvesting, or he could choose to go for that $3,000 of reduction on his income for the year. Either way, he's improving his tax situation and being able to make more moves with his investments. Better yet, once he's retired, he will have a lot more room to do a lot more harvesting since he knows he's going to be dropping all the way down to a 10% income bracket, which was part of his plan. So optimizing capital gains, this is an important part of any early retirement program. I'm going to mention early retirement quite a few times here because I have to say it was a driving factor for me and I know how powerful it can be. Overpaying taxes can be avoided because it's just a simple amount of math. Once you know where you stand, you can do the calculation and you can even offset some of the risk since the pain of losses can be dimmed by the offset of the tax burden on those gains. Just again, be careful that wash sale rule. So with income and capital gains optimized, you're going to start feeling really on track towards a strong retirement. But there's more that we can do here. What about your actual taxes in retirement? How do we go about optimizing tax retirement accounts? That is next. Have you been saving for retirement but unsure how it will impact your future taxes? Are you unsure if you'll have a high tax bill in retirement because of required minimum distributions or other income sources like Social Security? And have you considered Roth conversions, but you're unsure if it would be right for you? Overall, look, people fear taking money from retirement accounts before the age of 59 and a half because of penalties. But that doesn't mean that over contributing to pre-tax accounts has to be an issue. And money in after-tax accounts can make a big deal when it comes to our situation later in life. Roth conversions and withdrawal planning, these are the two strategies I'm going to talk about next because these can help prevent future tax headaches and can help you keep your retirement income flexible. But it only makes sense to pay that price to do this optimization in some situations. And I'm going to go touch on that as well. Consider Setzer, though. He's been maxing out his employer's pre-tax 401k. And now, before I mentioned, he opened a traditional IRA to get his taxable income lower every year. He's been doing these optimizations. But by doing this, he's also created a new problem for himself because he's now seeing that so much money in all these pre-tax retirement accounts is going to create too much income for him later in life, because his goal was to stay in a 10% income tax bracket, which looked fine before. He had been looking at his passive income and even at his future Social Security payments, but he missed including the required minimum distributions that hit at the age of 73, being forced to take money out of his pre-tax accounts at a certain amount. That is pushing him past his 10% bracket. And that's not what he was looking to do. He doesn't want to pay out those taxes. He needs to optimize even further. And that gets me into the next key strategies for the Project 3. The first is, while working and still having all that income coming in, making sure that we're doing the most we can in after-tax retirement accounts. So the Roth IRA. In 2025, the limits are small. It's like $6,500 can be contributed to a Roth IRA per year. When you get older, though, there's a catch-up that can happen. It goes up another $1,000, $7,500 if you're 50 or older. And these are current limits. These do change, but they almost always stay really low. And on top of that, how much income you make, that can prevent you from even contributing at all. So you have to look at all of these things, and you might find, I can't even really get money into these accounts. But the good news is you probably can. You can consider doing backdoor contributions where you're putting money into your traditional and converting it into your Roth to avoid having to pay the limit. Now, you're hitting taxes when you do this. You're actually going to be paying taxes on this conversion, but it can be worth it because once it's in the Roth, it's growing tax-free, and it's going to optimize a tax situation for you further down the line. On top of that, even if you're like, well, I can't even contribute that much to a traditional, so that's not helping me too much, you could actually consider doing a mega backdoor using all of your, using actually a compatible 401k account, like an after-tax 401k account. This has to be compatible. It has to be allowed. Not all accounts will allow you to do this. But if you have an after-tax 401k account, because a Roth account's an after-tax, you could just roll as much as you want into that, really bolstering up that Roth account, hopefully maximizing your investments and getting more out of that later. So there are some ways to try to get money in that, but the goal is whatever you do, do the most you can optimizing, putting money into that Roth account as early as possible in life. And keep doing it every single year and make that part of your plan. And when you leave your job, consider rolling over any employer-sponsored 401ks or similar plans, 403bs, whatever, into your IRA. This will help you maintain tax advantages and avoid penalties. You have to consider doing this right, though. So traditional IRA rollovers, you will keep the money tax deferred, meaning you're not going to pay any taxes yet. Remember, it's deferred, meaning later when you use it, it becomes income tax. So you want to, if you have a pre-tax 401k, you're going to want to roll that into a pre-tax IRA. So a traditional. But if you were to go from a pre-tax to an after-tax, you're going to pay all the taxes at that time of conversion. That can be very, 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 very painful. Now, you might be like, that's okay. It's still growing tax-free. Still, I don't know. Like, if you're thinking of doing that, you really should talk to an expert on that and see if it might be worthwhile or not. Also, keep in mind, you can't do a rollover whenever you want. Usually there's a window. It can be 60 days. It depends on the account. So if you do leave an employer, you do want to take action. You want to make sure you're optimizing your future tax situation by doing what you can with your retirement accounts. Okay, well, the whole point, though, is setting yourself up for the future to avoid a big problem. And that big problem is something called required minimum distributions, or RMDs. These start at age 73 on pre-tax accounts. So that, pre-tax 401k, if you were to keep that, or on your traditional. Basically meaning once you're 73, you're forced to take a percentage every year out of the account, which means you're forced, unless you pay a penalty, to add to your income and therefore to your tax situation. You might go, so what? That's just more money. Who cares? Well, if your goal is to pay less taxes at that time, because the money, I promise at those ages, you're really paying attention to cash flow. that this can actually be kind of irritating. And you might be like, okay, well, I'm spending thousands of dollars more in taxes than I really wanted to. Well, the good news is you can actually avoid this problem in the first place, but you can't do it while you're working. Not really. And while you're working, the best you can do is build up those after-tax accounts. But again, there's limits. But if you go into an early retirement situation, or you're between jobs, or whatever it is, you can actually start to make some progress here by doing a Roth rollover conversion. Now, again, you're going to pay taxes on this, but the idea is that you're selectively paying taxes on this so that you can set yourself up to pay way less taxes overall later and ideally avoid RMDs completely. So a Roth conversion is just moving money from any tax deferred account, to your traditional IRA or traditional 401k, to your Roth. That's what it is. It's just moving money. It's like it's like doing a little rollover. Now you get to pick though what you're converting. And that's what's really important here, because you're going to want to choose or select the shares with the lowest cost basis, meaning, the lowest price, in order to get the largest possible taxable gain. So basically because you're still making money, or, if you're in a low income situation, you can actually pick more cost basis, which is great. The idea is understand how much extra taxes you're willing to pay now in order to save how much more later. And this is why this is not for everybody. Well, first, you might not be in a position where RMDs are even going to be an issue for you. Maybe you just don't have enough in pre-tax accounts, or you're not leaning on retirement accounts as heavily as others because Social Security and other things are going to do the heavy lifting for you. But if you do have this issue where RMDs are going to be an issue for you, you're going to want to have some period in your plan where you can start doing these rollovers. Now, if you have no cost basis at all, you're going to pay full taxes on everything you convert. Also, if you have a mix of some pre-tax portions in there, you're only going to pay on those. So it can get a little complicated when you're selecting shares about how much taxes you're going to pay, but you can actually work with a CPA, which I highly, highly recommend doing, to figure that out before you do it, so you don't kind of screw yourself over on taxes that year. And when you're in an early retirement, you can actually even do this thing called a Roth conversion ladder. This will go even one step further for you and give you a tax-free passive income source before you're even 59 and a half. It's actually kind of amazing. I've been starting these myself. You just start converting from a traditional IRA or again, traditional 401k to your Roth each year while you're in your low income years. And then after 5 years from that conversion point, you can withdraw the conversion amount, not the gains, just the amount you converted. So let's say you converted, $10,000. You could take that $10,000 back out without penalty. That means you can create extra withdrawals for yourself before you're even allowed to typically take the money out. This is a great, I don't want to call it a loophole, but this is a great, optimization you can do to create a tax-free passive income cash flow source for yourself before you reach your standard retirement age, making it easier to bridge that gap. This isn't for everyone. Again, you have to have enough money to do these rollovers. They need to be significant. You have to be okay with like the tax hit you're taking each time. But, if you do have a lot to work with here, because you've all been dumping too much into pre-tax, you can solve multiple problems at once. Reduce or eliminate RMDs, give yourself more in after-tax Roth accounts, regardless of your limit, and you can ensure that you have passive income. Setzer is able to use this, and that's exactly what he's looking at right now. He's decided to quit work at the age of 60 and become an early retiree. And as he leaves work, he knows he needs to roll over his employer-owned pre-tax 401k into his traditional IRA. So he's pushing all of his money together, and he's not paying any taxes yet because these are compatible accounts. But he's deciding that he's going to work with a CPA here and start to determine how much of that $300,000, all in pre-tax dollars, he can start to get into his Roth in order to avoid paying as much in RMDs later when he's 73, because he knows he'll stay in the 10% tax bracket, but at 73, he's where he's going to jump up. And so he starts to do ladder conversions. And working with that CPA, he starts to find his smallest cost basis shares each year, rolling over the right amount and making sure that he's not pushing himself into a bad tax situation, optimizing himself overall. And look, optimizing with Roth conversions, this is not for everyone. It comes up a lot. I think it's exciting to people when they find out you can do this, but you do need a pretty hefty pre-tax account and other sources of income coming in later to make this a problem for you. And so if you have like a pension and a social security and maybe royalties and stuff, and all that's coming in because you did so great with passive income and everything's pre-tax, you might go, okay, I'm doing this. This is going to be completely worthwhile for me. And you just do the conversions once a year. So it's not a headache. You do it once, you pay the taxes, and you move on. And then 5 years later, if you want, you can take that amount back out. And that's why it's called a ladder. Every year you do a conversion, and then after 5 years, every year after that, you can take a withdrawal. So, that's great, but you might think that you've optimized everything at this point. You can do Roth ladder conversions, optimizing your retirement accounts. You can optimize your annual tax income situation, even your gains. But your primary income and retirement accounts aren't the only things that you can mitigate when it comes to taxes. There are other income sources as well, and that's what I'm going to cover next. Have you ever wondered how side income is taxed? How about your business? Curious if starting a business or getting a side gig would hurt or help you with taxes? Like even small side hustles, these actually can open big tax opportunities, especially if you treat them like a business. If you remember Setzer, he has his taxes fully under control now. That problem I mentioned at the top, he doesn't have that anymore. He's optimized everything. He feels great about his future. But his financial freedom plan includes building up passive income streams. He's been doing that. He wants to continue to do that in his early retirement. He's already making good money doing it as a freelance photographer. And he plans to dig in that during his early retirement because you got to have a purpose. You stay busy. But he's worried that if he does too well with it, he's just going to create another tax issue all over again. But the good news is in this project, I'm going to go into some key strategies for how you can continue to build your side gigs and passive income and still have other optimizations to leverage. So while working, you might start to build the muscle of treating your side gigs like a legitimate business. And it doesn't matter what your side gig is. Like whatever that thing you want to do to have another income source in your life, that diversification mitigation, that can be something that you do and set up and forget about, or it can be something you're constantly investing in. But the main idea here is that when you start to treat it like a business, you can actually set it up as a business and deduct all of your business related expenses as a result. This means keeping track of receipts of all the purchases. It could be equipment, supplies, software, marketing, whatever it is, including subscriptions that you might have for, making sure you can do your work. It could even include mileage for when you're driving. So you might get in the habit of starting to log your mileage because you can use IRS standard mileage rates, which I think is something like 65 cents or something per mile. It's probably higher now. That's probably an older number. But anyways, you can even deduct a portion of your home expenses like rent, utilities, or internet if you have a dedicated space that you're regularly using exclusively for work. Now, you're going to have to check all the restrictions here. You want to be careful. But when you do qualify, these can be really big tax optimizations. And I made sure the Escape the Clock Planner makes it easy to do this kind of thing. So as you go and you list out your expenses, you can actually start to tag things and categorize them. And you can mark the ones that you have for your business or your side gig versus your personal expenses to help you with automatic, summations and tracking and reports. So consider looking at that if you don't have your own sheet, but all you need is your own sheet. Track it however you want. And the idea here is you're trying to make your tax filing easier, and you're starting to create a sense of professionalism for yourself and even legal protection. And so you can even go further here. You can start to open separate bank accounts to separate the income you're earning from your side gig or even a personal business, because separating your finances will simplify your tracking and your taxes. You could also do what I did and create a limited liability company, an LLC. This is a legal structure that will protect your personal assets from business liabilities. It also can give you some degree of tax flexibility. It's really easy to do. Your state will likely have a website. You go in and you just register. You fill in a form. You pay a fee. You're done. And you're in a database. Just keep in mind, once you do that, you're going to get solicitations to whatever email and phone number you put in there. Don't do what I did and use a personal one. You'll regret it. Anyways, the other thing you might consider doing is creating a tax EIN or employer identification number. This is an official IRS tax identity that you can tie to your business. It's free to do this. And actually, it's often required to do this for certain types of stuff, especially if you're going to have employees. But it's, things like this is just good sanitation that you can do, adds credibility to what you're doing, and it can make your whole tax situation easier for yourself. But the main idea here is when you're done working, your primary income is gone, and you're either in early retirement or a standard retirement situation, you might find you want to grow your side gig into a proper business. If you're in that situation, there's lots of things you might want to consider. The first is any type of self-employment status. If you want to consider yourself working for yourself, which you can, then you're able to deduct 100% of all of your health insurance premiums that you pay for yourself, for your spouse, and any dependents. All of that comes out of your taxable income. So now you're further optimizing your taxes by the premiums that you pay on your healthcare. Healthcare is a big cost, especially in early retirement. So going into a self-employed status can help you further optimize there. The deduction will apply whether you itemize or take a standard deduction. So it's a nice one. So if you can get it, definitely go for it. But it's only available if you have no other employer-sponsored health coverage. So you can't be employed somewhere else. You can't have healthcare somewhere else. So you're trying to take healthcare from your spouse. You can't do this on top of it. This has to be your main thing. But doing this will reduce your adjustable gross income for the year and therefore your tax bill. The other thing you might think about is starting to shelter your side income gig and boosting your retirement savings to further reduce your current year taxes. The first option is a solo 401k. So if you did go to that self-employed status and you don't have any employees, you're just kind of doing your side gig, right? You're working for yourself. Your spouse doesn't count, by the way. So your spouse could be helping you. But anyways, this will allow a higher contribution limit for yourself when it comes to putting money away for your retirement. Your contributions will reduce your taxable income, just like when we were talking about all the pre-tax accounts. So it's a good way of continuing to bolster up your future standard retirement account while also managing your current tax situation in a lower income period. You might also find that you might be interested in the SEP IRA. These are easier to set up. The rules are simpler. You can also contribute up to 25% of your net self-employment income. And all the contributions you make to it are also tax deductible. So solo 401k, a SEP IRA, whichever you want to go, these can actually help you reduce your income as well. And so Setzer decides to go and take some of these steps to minimize his taxable income for the year through his side gig, because he has expenses. He's a photographer. He's trying to make even when he's working, he's making some income from it. So while he's working, he creates an LLC, he creates a separate checking account, he even creates a tax ID, and he starts to think of this as a freelance business for himself. He also starts tagging his freelance business expenses separately just to get into that habit. But when he goes into his early retirement, he just starts to lean in on this and make it into more of a proper business. He buys some new equipment, spends some more time traveling to events. He might even start marketing his work online more. Also, he knows health insurance is expensive, so he starts deducting his premiums since he decides to go ahead and declare himself as officially self-employed. He decides to open a SEP IRA account and contribute some of his earned business income there to further diversify his retirement accounts. And with so many deductions, he's feeling really great that no matter how successful he makes this business, he's taking the right steps tax-wise. And if it does really take off and he's making too much money, then he can afford to hire a permanent tax advisor to further help him find optimizations for his business. So overall, side gigs, they can be a big part of hitting our financial goals. They can make our lives a lot more stress-free, especially after we leave work. It could be royalties, rental income, paid services, whatever it is. All of these are taxable though, but they can also be deductible. So it's worth looking at local and federal allowances for this and trying to optimize where you can so that you aren't paying extra for your success. All right, we covered 4 big projects today. I hope these strategies were helpful. I also hope that the shorter format is useful. I think I'm still clocking a bit later than I want, so I'll continue to tighten this up. But I just wanted to kind of conclude here by mentioning how tax optimizations really start when you're an adult, and they will continue the rest of your life. And ignoring it can really mean just giving extra money to the government. And if that isn't a donation you planned for, then it's really worth taking some time to add these projects to your plan. And I didn't cover everything possible here. There's a lot of other things I could talk about in the future, the Augusta rule, tax benefits on trust, things like that. And I'll get to that if there's an interest in going deeper. And again, I'm not a tax advisor, but I can tell you that what I've covered here is enough for you to start taking the right steps forward. Because having the right accounts and contribution strategies and withdrawal strategies, these can mean paying little and sometimes no taxes. And it's best to review these things with a trusted tax advisor. I do that. I just like having that peace of mind. I try to do it myself and then I have it reviewed and I get a lot out of that. And honestly, it can be one of the best relationships you have because the way that you build on this relationship is to take on this service outside of the tax filing season. So you're actually meeting with them more often because when you're going through like Roth conversions or business deductions or tax harvesting, you can talk to a CPA about this anytime, not just during tax filing season. And they'll be very happy to do that. And they'll probably be more likely to prioritize you when it comes to filing your taxes later. And that's it for today's episode. I really hope you enjoyed this new format. If so, please share it with somebody. Also, you can leave me a comment. And I'd also like to hear from you. What was a time in your life when tax law either hurt you or saved you on something financially? Share your answer. Share it with the community. The best we can do is help each other out. Best of luck optimizing those taxes and escaping the clock. I'll speak with you next time. Thanks for tuning in to this episode. Remember, while I'm not yet a financial planner, I am getting my degree in wealth management. You should take anything you've heard here as tips and advice to making your plan. To learn more, visit www.escapetheclock.com. There, you can find the book, resources, including the planner, and you can even schedule time with me. Please remember to like and subscribe so you don't miss an episode. Thanks for tuning in, and I'll catch you next time.